everyone for joining, and good afternoon. My name is Ayodele, and I'm the Team Lead Prestige Clients Investment Advisory at First Asset Management. Thank you indeed for taking our time to attend this bootcamp, which is part of our drive to raise 100 million smart investors. While we wait for other attendees to join, I'd like to give a brief background about the 100 million smart investors campaign. The 100 million smart campaign is a movement to raise 100 million savvy investors in the Nigerian space. And this is done via educating us gradually to build, to improve our curiosity and build an online community to finally get capital growth. Today, we are diving into the benefits of investing in fixed income funds. And with me today, I have three beautiful and brilliant ladies. First, I have IfeOluwa Dixon, who is the head fixed income solutions at First Asset Management. I also have Tutu Owolabi-Kadiku, aka Double Two. She's the head fixed income at First Asset Management, and she covers emerging and frontier markets. And finally, I have Owolabi-Kadiku, who is the head of research at Rand Merchant Bank. She covers both the global and local markets. Thank you, ladies, for joining me today. And so let's start. Let's start today. We're saying that we're talking about the benefits of investing in fixed income fund. So Ife, I'll be starting with you. For those new to the space, people that really don't know what fixed income is, what exactly falls under the umbrella of fixed income investments?
Thank you, Ayodele, and good afternoon, everyone. Nice to be here. All right, to introduce the fixed income instrument or investment, as you might have said, I'd like to paint this scenario. So let's work this together, and to the audience. Emeka approaches you, Ayo, and requested for a loan of 500,000. You're willing to give Emeka the 500,000, but with some conditions. And you've stated in your conditions, it has to be paid over 12 months. You've also mentioned that there will be interest tied to it, so it's not free, so no free lunch. So Emeka will pay you, let's say, 10% per annum on that 500,000. You've also stated in your agreement the frequency at which you want to be receiving your interest. You could say 3 months, 6 months, or at the end of the 12 months for this scenario that we're painting. And so at the end of 3 months, it will be expected that Emeka will pay you 12.5, right? 25,000 if it's 6 months, or 50,000 at the end of the 12 months. In your own case, it's a predictable income. So you can predict your cash flows to say at the end of 3 months, you're expecting a 12,500 from Emeka, irrespective of what happens to Emeka's business or the economy, whether inflation moves up or down, your 12.5 will remain 12.5 or 25, meaning your 10% is intact. Nothing is going to change the 10% to a 20 or to a 5, right? So your 10 is fixed. That is a way that I would explain fixed income to new person coming into the investment space. To say fixed income is a category of investments that provide regular, stable, and predictable income. And it's usually in terms of a percentage. So interest is in terms of percentage. You say 10%, 5%, or 12%. For bonds, we usually call that coupons. So people might have heard coupons. And that origin of coupon also comes from a betting where they give you like a ticket or something that you provide at the end of a period to get your interest. So that is how I would explain fixed income. And also then, say to the person, it comes in various forms. So you have the government bonds. The government bonds is usually issued by national governments, a federal government in Nigeria, for example, meaning government has come to the market to say, borrow us money. So you give out money, they give you an interest also with a term saying 6 months. On quarterly basis, we'll be paying you interest back. And at the end of the defined maturity date, we'll be giving you back your principal. Now, also there is another instrument that is called a corporate bond, meaning it's being issued by companies, okay, that wants to borrow money as well. Pretty much fixed income is you're borrowing money. You have the short-term fixed income instrument, debt instruments, which is usually the treasury bills, the commercial papers, even our fixed deposit also. It is, a fixed income instrument. You have the fixed income mutual funds that pulls funds together and invest on behalf of unit holders. So these are examples of a fixed income instruments. And that is how I would explain to someone coming into the space, and new to say, it's predictable income, it's stable, and it's regular. Nothing will change that rate that has been given to you on a regular basis, except for when you then move into a more fancy, instrument. So for the basic, I will still stick to the fixed interest rates. Thank you, Ayo.
All right. Thank you so much, Ife. That was very interesting. I think my 5-year-old self understands it better. You've talked about fixed income as being predictable, stable, fixed, and defined maturity. I'd just like to mention to our attendees that there will be a Q&A session towards the end of the webinar. So please send your questions via the chat room so we can answer any questions that you may have. So coming to you now, Tutu. Ife mentioned government bonds. She mentioned corporate bonds. She said a maker can, even decide to give his money to the government. So tell us, how do government bonds, corporate bonds, and money market instruments differ in terms of risk and return?
Okay, thank you, Ayo, and thank you everyone for joining us today. Like she said, my name is Tutu, product of Grace. Now, when we think about fixed income instruments, for me, it's really just debt instruments, and it is you just lending money to someone in exchange for interest income. Now, just try to make this a bit relatable. We just got paid salary, I think, a few weeks ago. And if you're like me, anyone like me on the call, I'd actually spend that money before it actually came in. But in an ideal situation, ideally, you should allocate some of those funds to meet your basic needs. After that, maybe you try to allocate some to your wants. I mean, like I said, 30 December is around the corner, so obviously I want to allocate some funds to ensure that I have a good time. But coming back to basic, ideally, if I have some other funds left, what I really want to do is to try and see how I can lend or invest that fund. Coming back to fixed income instruments. So if I wanted to do that, really, there are a few things I'll take into consideration. One would be the credibility of who I'm lending that money to. Two, I'll also think about how long I'm willing to lend that money for. And then finally, I will think about the opportunity cost. That's the alternative for going if I'd used that money for something else. So now relating those three pillars I mentioned to your question around the correlation between risk and return and some of the examples of fixed income instruments that Ife mentioned. If we were to start with government bonds, now bonds in itself are debt instruments that are higher than 1 year in tenure. Ife already mentioned that, but as long as it's more than 1 year, it's a bond. Now, if you're looking at a government bond, they usually call them your safe haven assets. Well, Tutu calls them your sleep well at night investments. The investments that once you invest, you can actually sleep comfortably at night because you don't expect much surprises. To this end, these sort of investments will mainly have very moderate returns because really the risk is not a lot. Now, if we moved higher across the curve, you can now think of the corporate bonds, which Ife also mentioned. And I think you can liken this to maybe lending your money to the likes of, if I'm allowed to use it, this is not free publicity. Dangote, for example, I mean, that's someone that's quite respected in Nigeria. So corporate bonds can be likened to maybe lending your money to the likes of credible corporates like Dangote. And to that end, the element of risk, and when you compare them to government, is a bit higher. There's a jargon we use in finance called credit risk premium, which means if you're going to lend money to a credible corporate, ideally you want to get some compensation for the level of risk you're exposing yourself to. So, for example, the FGM bonds, maybe they are currently being issued at 15%. If Dangote came to me, Tutu, on that little money left for my salary, ideally I want to add maybe a 1 to 300 basis points on top of that, maybe lend to him at maybe 16 or 18%. So we move on to the other investment, which is money market instrument that Ife also mentioned. Like I was explaining to my cousin a few days ago, you can liken government bonds to maybe lending money to your parents because you expect them to pay you back. Maybe corporate bonds lending money to like those your reliable cousins that have enough to pay back. But when you're thinking about money market instruments, these are really short-dated instruments. I've mentioned that government bonds are usually anything. Once you hear bonds, there are things higher than 1 year. So money market are those short-term investments. So you can think of it like maybe an intern coming to an organization for a very short period of time. Because it's very, very short, you expect those returns to be slightly lower. And then you have various forms of money market instruments. You have the likes of treasury bills, which are issued by government. You have commercial papers and you have fixed deposits, which my dad loves, which is just placing your money with a credible bank and getting a fixed return at the end. So just answering your question, Ayo, it's fair to say that when you're thinking about all these various forms of debt instruments, you think of them as a team, right? Government bonds give you safety, corporate bonds give you higher return, and money market instruments should give you flexibility. And a smart investor will not pick one. A smart investor will invest across all of these debt instruments to be able to grow their wealth well and also sleep at night. And I think in closing, finally, you find out in the course of this webinar that there's actually a vehicle that we offer in-house here at First Asset Management that can give you exposure to all of these asset classes without even having so much. So I hope I've answered that question, Ayo. Thank you.
Fantastic. I like the sleep well investment you mentioned, and as smart investors, which we are building, with this webinar, you want, we would like investors to have assets across all this: government, sleep well, corporate, higher returns, so that their investment can work for them. I'd like to bring it home now, talking about what is happening, today in the economy. So Yomi, I'm coming straight to you. So Yomi, tell us, what is the perception of fixed income, right? And has this perception changed in the current economic environment? What are people saying about fixed income today?
Thank you, Ayodele, and good afternoon to the audience. Um, Maybe I should take us back through a bit of a timeline, right? And we have gone, and I'm not trying to show my age here, but we have gone from times where our parents would hammer on equity investments. If you're not holding stocks and shares of certain banks or certain manufacturing companies, it means that you're not, doing well, quote unquote. And that has since transitioned into, okay, embracing the fixed income space. But also people have looked at the fixed income space as, oh, okay, safe, but low yielding, low rate yielding, sorry. But we've now gotten to a point where we're in a high interest rate environment, right? And it's attractive. It's not just safe, but it's also very, very attractive. So I would say perceptions are shifting. So yields is on one hand, but safety on the other hand. The second perception that I think is also shifting is the fact that people had previously looked at fixed income as, oh, it's only for those with significant amounts of wealth and large pools of capital that go into, the fixed income space. Also, let's talk about treasury bills, bonds, euro bonds, and the likes. But no, that's actually changing, where with under 100,000 naira, thanks to innovation and technology, you're able to tap into so many different securities. And I dare say there's a much wider range than one can even imagine, right? And I'm sure the asset management business can talk a bit about it. So we're talking savings bonds, corporate bonds, sukuk bonds, and federal government bonds, euro bonds, for instance, which are foreign bonds issued to the foreign market or in dollar terms. But then we as domestic investors can also tap into that through asset management businesses and your wealth managers. So, like I said, perceptions have shifted, timeline, equities, a little bit of acceptance of fixed income space, but we've now got into a high interest rate environment, and all of a sudden you have safety and you have high yields to enable you compound and grow your wealth. I'll stop there. for now.
Interesting, Yomi. I can actually relate with this because I remember, my parents would say, oh, they have to buy shares in, some certain popular company, or the next thing would be maybe fixed income. That those were the two, most popular asset classes then. And now, just like you've mentioned, there's a shift, everything, there's a shift. My parents would also say, oh, your generation, there's always something different. So with with us at First Asset Management, you can easily access this data. And you've mentioned even the entry points is accessible. Everybody and anybody can access this asset class right now. So bringing it home to Tutu, Yomi has just mentioned, Tutu, I'm coming back to you. Yomi mentioned that, back then people would say, for me to build wealth or for us to be able to do some certain things, you must have stocks, right? Many investors associate wealth building with equities. How can fixed income also be a vehicle for long-term growth?
Interesting. Thank you so much, Aya, for that question, and Yomi for the wonderful feedback. Definitely, I can align with that in terms of my dad buying certain shares as well. But honestly, I think this is one important myth that we need to address, and because of this webinar, because many people tend to equate wealth building with only stocks. I'll add real estate and maybe business ownership. They tend to overlook the power of fixed income. They think maybe for you to build wealth, you have to take big risk. But in reality, Ayo, wealth is you build your wealth by really protecting what you already have and allowing it grow for you quietly. Now, fixed income does that for you. Now, it's not about the speed, right? It's about stability, it's about consistency, and it's also about compounding. Now, what do I mean by all of this? I'm sure. They say compounding is the eighth wonder of the world. I'm not sure if anyone in the audience have ever heard that, but that's a really powerful tool to actually grow your wealth. Now, to make this a bit more relatable, if you had or you were disciplined enough, and consistency also comes in here, to take maybe 1 million out of maybe your savings and invest, for example, in a bond fund, like a bond fund that ends maybe say around, I'll say 12%, and you were disciplined enough to reinvest that every year. In 10 years, that 1 million could have been 3.1 million without adding any extra cover, just that discipline to take that 1 million and invest it in a bond fund of 12%. And remember, bond yields are actually higher than that. You've typically just tripled your capital with the power of compounding. Now, Ayo, do you want to tell me that that is not building wealth? That didn't involve any exposure to either equities, real estate, or even, if I'm allowed to say, crypto.
Yeah.
Another scenario could be someone that took 50,000 naira monthly and invested in the same bond fund at 12%. 10 years from now, that money would be 11 million. Now, that is the power of consistency, because I mentioned consistency. Making intentional decision to take that 50,000 on a monthly basis will have led to 11 million just 10 years down the line. So the power of compounding cannot be underestimated, and that's a significant contributor to people that have actually grown their wealth. A good example is Warren Buffett. The way he has been able to grow his wealth is by really capitalizing on the power of compounding. And I would just advise that we do that. Another thing I just wanted to also mention around fixed income being a builder of what has to do with stability. Now, in very volatile markets where things are going up and down, fixed income serve as the shock absorber. Now, I have wonderful people in my team that love football. You can't just have strikers just striking every time. You need defenders as well. So fixed income is that defense mechanism that helps you to hold your portfolio when things are not really going well. And I think in closing, what I would just like to mention is, and this is facts, over the past decade, or will I say 10 years, in our market, in our context, money market funds have outperformed equities 6 out of the 10 years. And that is a fact because of the stability it provides to your portfolio. So what I'm saying in a nutshell is not like, I'm not telling you to ignore equities. I'm not telling you to ignore real estate. I'm saying that you should ensure that you also have an exposure to fixed income in your portfolio, because they're the heartbeat of stability in any particular portfolio. So while equities will build your wealth fast, fixed income will make that wealth last. And together with those two instruments, I can tell you that you are unstoppable as an investor. And that's where I'll just put a cut into it for now. Thank you,
I
Aya.
just wanted to jump in here. Tutu,
Yeah.
just to add, and I just like how you couched the conversation on compounding. And I wanted to add one extra layer to that, is that while you're compounding and for compounding to work, right, your capital is preserved through the fixed income process. So capital preservation is one of the significant benefits. There's no risk of erosion of that, that capital whilst you're compounding. So just as an extra layer to your compounding story.
Thank you. Fantastic, Yomi. Thank you, Tutu and Yomi. I'll take back stability from what you've said, summary, stability, consistency, compounding, and, Yomi added capital preservation. And really, what else do you need when you need to build wealth, when you have all this? If you have stability, if you're consistent, if you're disciplined, if you can compound your interest, and then you have your capital preservation. So yes, I believe fixed income can also, help you build your wealth. I'd like to come to Ife now. Please tell us, what role does fixed income play in a well-diversified investment portfolio?
And honestly, I think Tutu and
Tutu has said it all, I know.
explained, right? So, but to answer you, and maybe some people are just joining in, a whole lot have been said. And if for those that have joined earlier, you would see that there has been some terms that have been coming out regularly: stability, predictable, risk, return, liquidity. These are things that you need in a well-diversified investment. Like Tutu mentioned, we're not saying do not do equities or real estate, but what is that asset also that would bring about stability, that is not as volatile as your equity, that can give you a bit of a comfort, and also you would earn something because of that predictable cash flow that fixed income do provide. And so these are some of the roles, right? Yomi mentioned capital preservation is one of the things also. And it's less volatile than equities, especially when you're dealing in federal government bonds and some high-grade corporates as well that will not default. When you're dealing with the likes of Dangote, it's different from when you're dealing with IfeOluwa bond, and so that volatility in IfeOluwa will be higher than that of a Dangote bond. And so again, it brings about somewhat less volatility in a portfolio. That's what I would say. And also it helps to preserve capital. At least the amount you're bringing in, you're sure that your principal, if you come at a par, you are sure that your principal would come out clean as well, and your interest, all things being equal. There is also this steady income stream that is guaranteed. You know that at the end, like the example of Emeka that I've given, your 10% will remain at 10%. In terms of equity, even for the companies that do pay dividend regularly, we know that there are days that is 5 naira today, next day it could be 3, it could be 1. You can't really predict what that would be. But in terms of fixed income, there is a predictable cash flows to that. And so that is another thing you want to think about when you're looking at a portfolio. Also, you want to look at the diversification. Tutu mentioned that as well, always having these, even if it's going to be a pure fixed income instrument. We've mentioned corporate bonds, we've mentioned government bonds, we've mentioned short, term debt instruments, we've mentioned fixed income mutual funds as well. All these, do have they react in certain ways, not in the similar way at all. And so in terms of that, of having a well-diversified investment, you're thinking of risk, return, and liquidity, and fixed income instruments would give you that. So that is what I would say, that these are the roles that fixed income will play in your portfolio.
Thank you very much, Ife. Thank you. I like the stability part. These days you need some stability, and you need some something that can also help you preserve your capital. And I guess we are not saying that you can't invest in your stocks or your equities, but also you need something that would balance out your portfolio, that would create a diversified portfolio. And that is what we're preaching today. So Yomi, I'm coming back to you. We've talked about fixed income. We've been talking about, the fact that it's stable, predictable, the capital preservation. So what are some of the common mistakes investors make when approaching fixed income?
Oh dear. Is this a trick question?
No, it's not. It's not. We're here to enlighten our attendees.
There are quite a few. And I really do think the wider conversation to include should be to include this in the curriculum. But let's that's besides the point. Some of the key mistakes that I have seen in my experience, and I have also experienced, starting with locking away funds without having a wider strategy around emergencies. So you put your funds in a specific tenor, and then you realize, oops, I don't have any cash. So it speaks to the wider sort of financial literacy and financial strategy as we're trying to build, 100 million investors to actually try and balance out what your expected outflows are, with how much. And I know it's attractive. You want, yield, you want to put everything in, but you also don't want to come to a need and then have to go and borrow money at much higher rates. So it's balancing out your emergencies with how much you want to invest. That's one. I think another thing is for wealth and for the compounding story that we're talking about, right? We have to be disciplined in that, okay, one matures, we go out and party and spend it all, right?
Whereas, just like Tutu talking about dirty December.
Exactly. So ensuring that we cultivate a mindset of discipline where we're reinvesting, if not all of it, but a significant portion of it to compound our wealth. That's the only way it will work. Right. So we shouldn't treat it as just, sort of a short term, okay, yes, just to make some quick money. I think the other part of it is just in terms of understanding the risks of the different, the different buckets. The different products have risks. We all need to be mindful of what the risks are. So corporate bonds, for instance, as one of my panelists has talked about, in terms of the risk premium placed on that, so corporate bonds versus government bonds. So just understanding the different risk categories in the different buckets. I think, yeah. Oh, one more thing. Taxes. And as the chairman of the Presidential Committee on the Tax Reforms, Mr. Ayodele keeps stressing, one of the things that's showing life is taxes. So ensuring that one is aware of the sort of taxes that apply to the product that you're investing in, such that you can make a tax adjusted decision, right? So a risk decision on what you're expected to get back out. Just even to factor that in. So I think these are things that we all just need. So whether it's a risk or whether it's your financial structure, emergencies, whether it's the tax adjusted returns, these are all the things that, we often just say, okay, I'm just going to put it in. They're giving me the figure of the yield, but we all need to consider these things in terms of, and I've made those mistakes in the past as well. So.
Okay. I think we've all made this kind of mistake, because I have as well. I like the fact that you talked about risk. It's always it's one thing that keeps sticking out when you're talking about investments. And I like to come to Tutu now. Ask her, how can investors assess their risk tolerance before investing in bonds or fixed income funds?
Well, like you mentioned, that's another big common mistake, right? Most people say, I don't have much money, I can't do it. Risk tolerance is not about how much money you have, right? It's really about how much uncertainty you can handle as an individual. And as they say, we're not all the same. What applies to me might not really apply to you. So taking that time out to understand your risk tolerance is quite important. I mean, in my past life, I think many years ago, when we were writing, I think level 3 CFA, you have to do your IPS where you need to understand risk tolerance to be able to ensure you're giving the client the best advice, really. It's about your willingness and your ability to tolerate risk. That's quite important, especially when markets are moving up and down, so that you don't take any sort of impulsive decisions, right? And then willingness and ability. What do I mean by that? You might be willing to do something, but you might not have the ability to do so. Now, let's try and make this a bit more relatable. So let's take, for example, maybe I like using my dad. I need to be paying him for every time I use him on this webinars. So my dad's 60 years old, for example. Now he's retired. He's not earning any sort of money, but he loves maybe bungee jumping. He loves fast cars. He loves everything risky. In terms of willingness, he's willing to do that. But in terms of ability, he's not earning as much as he used to earn before. So he can't really take that much risk. So if I was to classify my dad, obviously it comes into the conservative bucket in terms of risk tolerance. And I think a lot of people on this webinar will be asking, how do I really evaluate and understand where I fall? Am I more of a conservative investor? Am I moderate, or am I on the aggressive spectrum? One way we can do that is through risk assessment questionnaires. I mean, these are available online on various platforms for you to actually answer a few questions. And with that, you're able to profile what kind of risks you are able to take, and that will most likely determine the best investment for you. Apart from that, what I also advise is actually seeing a professional investment advisors. They will be able to provide a more detailed response in terms of what your risk tolerance level is. So they also consider your unique constraints. So people have very unique needs. Like I mentioned, we are not all the same. We're all quite different. So sitting with an investment advisor would also enable us to have a broader picture of other things that have to do with specifically you. And I think I really the last simple one, which can even do on this webinar, is really just self-assessment. You can ask yourself very simple questions. What's your objective? Why am I investing? Am I investing for income? Am I investing for safety? Or am I investing for long-term growth? Another question you could ask was the one I asked at the beginning of this webinar. How long am I willing to let this money go for? So what's your time horizon? Is this something that you need the money in the short run? You're going to lock it for a long time. Another question you could ask yourself even here is, how do you tend to react when you see your investment fall by 5% or move by 10%? That would also put you into a particular bucket to ensure that you really understand yourself. I mean, I would say that knowing your risk tolerance is like knowing your blood pressure, right? You only invest wisely if you know what you can tolerate, so that you can sleep at night. So the first step is really understanding what's unique to you, what you can really take, what's your willingness, what's your ability, what's your objective behind the investment. And I think in closing, I'll just state quickly as well, because we at First Asset Management are regulated by the Securities and Exchange Commission, and there's a particular rule there that says that even before any licensed fund manager can actually recommend any product, they should actually ensure that they're actually doing the risk assessment of their clients, so that we're able to offer you the right products. Having said that, it's also your duty as an investor to understand what really works for you, because circumstances do change. And even though your fund manager might put you in this profile, maybe you won the lottery or you did bet and you won whatever you want, your circumstances have changed. So your risk tolerance may actually increase or decrease. So I would say let's just take a conscious effort to understand really what works for us as individuals. And that's just risk tolerance, understand your willingness and your ability. Thank you.
Okay. Thank you, Tutu. When you were talking, I was just listening, and I remembered, some of my clients would say, I can take risk, but I don't want to lose money. You get that offer. You say, oh, yes, I want to take the risk, but I don't want any drop. So, it's very important to, assess your risk tolerance. So I'm thinking, Ife, should I come to you now? Ife, or should I come to you, Yomi? Yomi, you can chip in, please. What simple first steps can someone take today to start building wealth through fixed income?
Is that for me or Yomi?
I'll start it. Let me start it. Okay. The very first step is to, like Tutu said, sort of assess your risk tolerance, but more importantly, speak to someone. And one of those people could be Ife. So Ife, you can take it away from here.
Nice. All right. Thanks, Yomi. First steps. I think Tutu painted the picture, and a very good one, which is know yourself. When you know yourself, you know what. And I also mentioned we've had instances of clients saying, I can take risk. Yeah, don't worry, because the return was looking good. And until when the eventuality would then happen, we'll be like, No, not a 1 kobo drop from my principal, you will get that. And so it's about knowing yourself, and in understanding yourself, you then need to understand your financial goals. So that will be my first step or advice to anyone, to say, understand your financial goals. Why do you want to invest? I think you need to understand that. Do I want a regular income? Am I saving for retirement? Am I saving to buy a car? Am I saving to build a house? What am I saving for? And do I need a low risk investment? Tutu has mentioned somewhat like a risk return, principle as well. So for low risk investments, the return also will not be that great as a high risk investment. And also volatility would play in that region. And so when you understand your financial goals and say, for argument's sake, if you're saving towards something, you don't want your principal to drop because you want it to increase. So that in a way would inform the kind of investment you would go into and the kind of return you're looking for as well, and how regular you want that income. So that will be one. Another that I would say is start with low risk investment, so that she mentioned high blood pressure. You don't want a situation where you are not sleeping. So start with low risk investments. Low risk investments, treasury bills, government-backed securities, really, and also federal government bond. Your principal will be safe because we spoke about capital preservation, and you would have your regular income, which is a predictable cash flow. Might not be as great, but your investment is safe in some shape or form. Another that I would tell you to do is you automate your regular contributions. These are steps that you could have. You regulate you automate your regular contributions after I've said, do I want a regular income? This is my financial goals. Do you want to be paying in every month? Do you want to be doing it every quarter or semi-annual? Or it might even be at the start of the year if you have a bonus, if you have just a high cash, that comes in at the beginning of the year, you then just want to set something aside. And so that also is another step in building wealth. Now we're talking about building wealth. I've said 1, understand your financial goal in building wealth. 2, start with low risk investments. When you enjoy the journey and the interest, you can then be going into a medium risk and then graduate into high risk investments. The third I've mentioned is automate your regular income. And if you've been part of these boot camp, you would know that we've been mentioning all these steps as well, from Bootcamp 1.0, 2.0 to 3.0. This is 4.0. We've mentioned these over time. Understand your financial goals, low risk investments, baby steps, sort of. And also, I've said automate your regular contribution. Another is obviously you open an investment account before even you open, you do your regular contributions. You open an investment account also. That in a way, you are putting money aside on a regular basis. Next is you monitor and you reinvest. You monitor. When you see how your fund is growing, you will be excited to do more. And so you need to also have that in mind, and always take your assessments like Tutu mentioned, because things may change. Am I really willing to go on the high risk journey now with this my age and with what I'm targeting? Maybe I should start moderating down to medium or even go to low. These are things that you just need assessment over time. You can't stop it and you can't just dump money and look away. You need to monitor, and monitoring will ensure that you are bringing in, because you'll be excited when you're seeing your money grow. You want to do more. So these are my steps that I would advise anyone.
Thank you very much, Ife. I'll just like to remind our attendees that you can, drop your question in the Q&A session in the chat box, and we can, would ask questions before the end of this program. Ife, all you've said is we've been saying, the same thing. You've said understand your objective, start with low risk, automate your contribution, monitor and reinvest, invest. I'd also like to chip in, invest with a reliable and registered investment manager like First Asset Management, because we're registered by the Securities and Exchange Commission. So over to you, Tutu.
Me? Okay, let's go. I'm ready.
Yes,
Let's go.
Tutu. I'm back to you. So I have this question for you, right? What should investors look for when selecting a fixed income manager or generally a fund manager?
It's an interesting one, which I like because you're not just choosing a product when you're choosing a fund or investment manager, you're choosing a partner to protect the money that you've actually worked hard
The
for. So
hard-earned money
this
that I
is
worked
something
for.
that you should really take your time, right? I mean, I don't want to give publicity to those Ponzi schemes, so it's quite important. So I'll just, in the interest of time, because I know time is fast spent, just mention maybe four pillars. The first one has to do with regulatory licensing and oversight. In Nigeria, every legitimate mutual fund and fund manager is licensed, is monitored, and approved by the Securities and Exchange Commission. So, my people, before you invest, confirm that this particular fund is registered via the SEC website. There's a portal called SEC Nigeria's Fund Portal because this is the first layer of safety you get. So, having established that this particular fund or fund manager is regulated by the SEC, the next step I would most likely advise is you look out for a few things. One, clear communication. Now they publicize 17%, 21%, 50%, right? Can you please try and understand the underlying assets driving that particular return? Where are they putting your money? Those are questions that you should ask. Are they in T-bills like we mentioned, or corporate bonds, or euro bonds, or commercial papers? Try and understand, get clear communication on where they're putting your money. The second thing is consistency always beats excitement, right? They did 50% today. Seven. How consistent is this fund manager? How consistent is the performance of this fund? Look for steady historical performance. 3 years, 5 years, on an average, gives you an idea of how these funds will perform. The last thing I also wanted to quickly mention because of time is transparency. How transparent are these people? Like I say, trust is the bedrock of any relationship, your personal life or your even in your career or even with your investment. So you must also invest with fund managers that are able to give you fact sheets, their quarterly reports, their disclosures, their clear communication channels where you can ask questions. Those are things that you should look out for. And then finally, integrity and expertise is also quite important. What's the pedigree of this particular institution? How long have they been around? Right? What sort of fund managers are managing their portfolios? All those things are things you look at before deciding on which fund to invest in, amongst all we mentioned, because your objective is quite key. Your time horizon is quite key to understand if it's aligned to the products that you want to invest in. So, in closing, Ayo, quite a lot, but most importantly, your first layer of safety is, are they regulated by the Securities and Exchange Commission? Clear communication, what's driving the performance that they are preaching, their track record, how transparent are they, and the integrity and expertise of those managing that particular portfolio. And at first asset management, if I'm allowed to say that, we actually comply with all the SEC rules, right? When we're and the trust deed of the funds that we do manage in-house to ensure that investors' interests always come first. And that's it, Ayo. Thank you.
Thank you, Tutu. Yomi, do you have something to say?
Yes, I just wanted to add to Tutu's very clear instructions. And that's sort of the cherry on the top when you finally know that an institution is one that you should engage in with credit ratings. So there are fund managers that have credit ratings, investment manager ratings, and then based on the quality of the ratings that there are people that you can speak to. Just wanted to add that.
Oh, thank you, Yomi. And just in our local parlance, they say "follow who know road." So, yes. So Tutu, or maybe I should go to Ife now. Let's bring it home. We're bringing it home. So we're talking about why First Asset Management is the right investment partner. Ife, can you tell us some of the mutual funds that we offer at First Asset Management that can help people grow their wealth?
We have like 7 or 8 mutual funds, right? And so we have a whole lot from low to high risk investment. And so for people that want to, I don't want anything to touch my capital, we have funds that speaks to that. For people that are willing to take, a bit of a medium risk kind of a thing that will reflect in their income as well, we have high risk mutual funds as well, our equity-based as well, mutual funds. And we have in local currency, we have in foreign currencies, right? For the sake of this webinar that speaks to fixed income, I will just dwell on fixed income, right? So that we're not confusing our audience. So we have the money market fund. That's one of our major flagship, if you want to call it a flagship for any asset manager in the country, to be honest. And so that fund is a low risk, like I mentioned, is a short-term debt instruments that are in there, nothing more, nothing long-term. So it's short and it's low risk based, and the return, it's fantastic, higher than what you will get from the treasury bills, right? Higher from what you will get from a normal fixed deposit. And the beauty of mutual funds generally is because you're pulling funds together, the fund manager then has the muscle to go out and get a better return for every contributor, every unit holder. And so for our money market fund, currently above 17, close to 18%, that is the return we've done 2023 in time past, but again, it mirrors market reality. We have our Allow fund as well that speaks to the people that are ethically inclined. So not only, yes, it's allowed, but not only meant for Muslim brothers, or it's also for Muslim or Christian. Just because if you are ethically inclined, then that fund speaks to it. And like the word is allowed, so it doesn't have any interest-based instruments in it. Nothing like alcohol, gambling, or conventional banking instruments is in it. It's pure Sharia compliant investment. And that speaks to diversification as well as stability, and income on halal is being, or return is being distributed annually. Whatever the mutual fund, happens to achieve at the end of the year will be distributed to the unit holders. If my memory serves me right, from inception, Allow Fund was launched in 2020, mid-2020. Until date, it has returned above 90%, over inception. That's 2020 till date, is done about 91%. And so again, to give comfort, because some people, in terms of return, it's interest-based, maybe there is no return. There is return. We share profit with unit holders, and that's why I'm laying emphasis on this fund. We have our bond fund as well, right, that pays income on an annual basis as well. And so the bond fund mirrors different forms of fixed income instruments, from short to the long-term debt instruments. So I'll stay with that. I don't know if Tutu, do you want to come in and just...
Did you have anything to...
Yes, so I have for my just got back clients, my diaspora clients, my debt to December kind of clients, right? We also do have foreign currency portfolios as well. Like you very rightfully mentioned as well. It's quite important that we also clarify that these are open-ended funds, so you can liken them to your savings account. So access is there, so you can put the monies in, but at the same time, when you do need your funds, you can actually redeem from these portfolios. Now, coming back to my IJB clients, if you look at that particular space, US Treasuries 20-30 year bonds are 4.6, 4.5%, which is very, very low. Nigeria actually just came into the market just yesterday and were able to raise quite a significant chunk from the market. So why should you not benefit from this? You are Nigerian as it is. And if you have mutual funds that can give you access, indirect access to this particular investment, the question is why not? So with as little as $100, you can actually gain exposure to this sort of instruments, giving you as high as 7 to 9% in the market. So we do have these debt instruments that invest in credible government securities. It's quite clear that we state that. We mentioned in the course of this that they are debt instruments, but it's quite important that you invest with credible players in the market to avoid instances of default. So back to our funds, which are, I'll call them my babies, in-house, the dollar products, with as little as $100, you can gain exposure to them. Performance-wise, I don't want to blow our horns, but performance has been quite steady and there's a good track record on those investments. And for those that know IJB, that if yeah, what's bad in actually diversifying your portfolio, this dollar-denominated investment also provide a hedge against inflation. They also help to preserve your wealth. And just in case you're also planning for your children to school abroad, holidays, you can just get income from these particular funds, which pay distribution semi-annually. Annually. Having said that, like I mentioned, they are open-ended, so you can always access those pool of funds when you need it. For the dollar fund, that particular one, like I mentioned, with $100, you have access to that. And just to blow our horns a little bit, between 2018 and 2025, that particular fund delivered about 68.34% in terms of return. So imagine if I'd actually invested $1,000 in 2018. Any idea where that would be? 1,683.40 in 2025. So, and that is not factoring the fact that you could have converted that money to naira and use it for something else. So overall, it's quite important that you also diversify your portfolio, both from a currency perspective and geographical perspective. And we do have funds that cater to that. I think time is fast spent.
Thank you, Tutu. I like the fact that what you mentioned that resonates with me is the fact that the entry level, the entry point is actually very low. So it means that it's accessible. The accessibility is accessible to all your IJGBs, as you mentioned. All right. Okay. So thank you so much, Tutu, and thank you to all the panelists. I have one question to ask in the chat room here. Someone has asked, what do you mean by high or low risk investments? What are the examples? Tutu, do you want to take that?
Oh, sure. Thank you so much for staying with us. I mean, till now, we do appreciate your time. So low risk and high risk investment. So let's quickly. Now, when you talk about low risk, we mentioned that to just sleep well at night sort of investment. Those are low risk because they are issued by the government. And like I always say, don't say this anywhere, is they can always print money. So the default rate you expect is not as much, particularly if it's in a low currency, right? So like your treasury bills, your money market funds that invest in very short dated instruments, I'll classify that as low risk, right? Because those you can plan with. If you have rent to pay, you have an objective you're trying to meet in the short term, that is low risk. Now, medium risk, it's moving higher up. Now, I mentioned something around maybe lending money to your cousin, that is okay, which can liken to the likes of maybe credible institutions like your Dangotes, if I'm allowed to use, and very credible names that I use every day, right? Those particular are a little bit, in terms of risks, are higher because obviously you're exposing yourself to their businesses and microeconomic shocks. So there will also be some times when the portfolios that are exposed to these asset classes would experience, how do I put it now? I don't want to use a particular word, but medium risk. So I don't want to use that word, and I'm not going to use it. I said I'm not going to use it on this call. But what is clear is that in terms of medium risk, it's exposure to not risk-free assets. So let's say exposure to a corporate that is not government. So the risk ladder is a bit higher. In terms of the duration of the investment, it's longer. Imagine if you give someone your money for 30 days as opposed to giving that money for like a year. Obviously, there's a longer risk. Anything could have happened to that person within that time period. So that's more risky. So that's where corporate bonds and bonds generally fall into. And then finally, the high risky ones are the equities, of course, because of the volatility and the shocks that you get from those sort of investment, real estate, cryptos. If you have people that do that as well, they tend to move up and down, right? So I think that's how it's classified. I hope I helped. Thank you.
Yes. Thank you so much, Tutu. Thank you. Thank you to my panelists. Yomi, I'll just like you to give us like a closing remark. What should our attendees do from today after listening or watching this webinar?
Oh gosh. Okay. There are quite a few things to do, and you've got a laundry list of things to do now. But I want to start with first of all, pay attention to the macroeconomy of Nigeria. Every single event, there is an opportunity embedded in that. If inflation is high, right? Yes, I know that sort of tends to pinch us all, but at the same time, chances are your returns will be high as well in terms of investments. If you pay attention to government borrowings, the government might need to borrow to fund the budget. There's a deficit, right? That means that they are issuing. Am I frozen? That means that they would need to issue more securities that you can invest in, meaning there are more options on the table. So every event on the macroeconomic side of things, right, has an opportunity embedded in there. And dovetailing from that, ask questions. Ask questions. Nobody ever got knocked for asking questions. Ask questions, ask your wealth managers, ask your friends, ask research analysts, go on the internet, just keep asking questions. I think those are the two things that I really wanted to highlight. Pay attention to the macroeconomic environment and ask questions.
Thank you so much, Yomi. Well, the person that asks this question doesn't, miss his or her way anyways. So yeah, I agree with you. Tutu, do you have any final words?
Oh, yes, I do. I just want to say thank you, everyone, for joining us. And I think what's clear to me is wealth isn't built overnight, right? It's built over time, one discipline decision at a time. So, this is a call to action in terms of what we've discussed so far. Begin with mutual funds or government securities approved by the Securities and Exchange Commission. Diversify both locally and with USD investments, right? Automate your investments to maximize the power of compounding. If you don't take anything from this, please take away the power of compounding and align your investment horizon with your goals. That's quite important. And you start where you are, even with 5,000 naira, you can begin your financial journey to independence. That's it for me. Thank you.
Thank you, Tutu. Finally, Ife.
Now you're coming to me. So yes, we've said ask questions, but ultimately ask the right people. Because in Lagos, especially, if you ask someone who doesn't know road to give you to describe a place, you just go straight down, turn right, turn left, and you will not get to anywhere. So, but we're saying ask the right asset manager, and Tutu has explained Securities and Exchange Commission registered fund manager, and we are one. And so, I mean, why go outside when you can come in and ask us questions? And I believe that we've explained, fixed income investing, and we've shown you how bonds and other instruments can play a steady, reliable role in your financial journey. So whether you're looking for income, stability, or diversification, fixed income offers, valuable tools to help you to reach your goals. And we say, why not partner with us and let us just help you to build our wealth using our fixed income expertise. Thank you.
Thank you so much. Thank you, Tutu, Ife, Yomi. Thank you. We appreciate your time. And thank you to our attendees. I hope we've been able to, break down all this information, all this financial journey. And we hope that you would partner with First Asset Management today and make us, your financial investment manager of choice. Thank you, everyone, for joining. Please don't forget to follow our social media page at First Asset Management. You can also send us an email. Please send an email to talk to us at firstassetmanagement.com, and we'll be happy to guide you, to your financial, we hold your hands, with you to your financial growth or your financial goal. Thank you very much, everyone. We wish you a safe and productive day. Thank you.
Thank
Bye.
you. Bye.